Welcome back to the Bitcoin Layer. I'm Nick Bhatia, and in today's episode, I'm going to walk you through the crowding out effect and why it is so important to understand this year. At the Bitcoin Layer, we are advocates of self-custody, and there's no easier way to self-custody your Bitcoin than Envoy. Stay tuned to the video to find out more. Okay. Crowding out. What is this concept? Basically, think about it like this. You have a set of investments available to you in the world. Stocks, bonds, real estate. And then you have this other investment asset class called Treasury bills. These are short-term instruments issued by the US government with an extremely low likelihood of default. So you have all these different asset classes. Now, if the risk-free asset class has a very attractive yield, that makes other asset classes less attractive relative to treasury bills. So that's the general idea behind crowding out. Now, what do we have this year in 2023? We have a confluence of crowding out effects right now affecting investors and their behavior. So let's break it down. Number one, Treasury bill yields have reached levels that are equivalent to the expected return on investment-grade bonds as well as dividends from stocks. So, what does this mean? Let's take a look at this chart right here that has been going around on the internet this week from the Financial Times. It shows you here that the Treasury bill yield has risen steadily from near zero levels to a point above 5%, where we actually see corporate bonds and stocks expected returns all reaching an equivalent area right here, just about 5%. So this means that if you're an investor, you're looking at 5% yield from treasury bills or corporate bonds or stock dividends. Now, if you're looking at these three asset classes, you have to assign different levels of risk to each when trying to make a decision on which investment to participate in. And so it becomes very obvious that a 5% treasury bill is going to be a much better investment on a risk-adjusted basis versus those two other assets. So the crowding out effect then comes into play as investors elect to buy treasury bills and elect not to buy corporate bonds and stocks. So in that way, treasury bill yields are crowding out investment for other asset classes. Now, why are treasury bill yields at 5%? Well, it's very simple. The Fed has raised rates from 0 to 5% since March of 2022. So that means the Fed is in charge of trying to drive the crowding out effect via this channel. So what the Fed has done is it's raised rates in order to motivate investors to not take as much risk, and that risk-taking behavior can drive inflation and inflationary dynamics. So this is why you see the Fed, part of why you see the Fed raising rates. One of the reasons is to crowd out other investment. Okay, number two. This is the crowding out effect that we get from the large issuance of treasuries coupled with quantitative tightening. So there's been a lot of focus on the rebuild of the Treasury General Account after the debt ceiling resolution, but let's ignore that dynamic for a second, which does contribute to the crowding out effect, but let's just go to the fundamentals of issuance from the Treasury and what that does. So let's say the Treasury issues approximately $1 trillion of treasuries per year. Now the actual number can be much larger, but just for the sake of argument, let's pretend that the Treasury issues 1 trillion of treasuries per year. Well, the next year, if there are 1 trillion of treasuries maturing and the Treasury issues 2 trillion of treasuries, that is a net increase of 1 trillion of treasuries. And in fixed income, we say that this hits private hands. Why private hands? Because the Fed is not an active participant right now. The Fed is not doing QE. It is doing QT, meaning that it's letting treasuries mature from its own balance sheet. So if those treasuries mature from the Fed's balance sheet, but are then issued by the Treasury, that means those treasuries have to go to private hands. Those private hands can be investors, foreign investors, asset managers, all of those types of investors, but not the Federal Reserve. Joe and I take self-custody very seriously, and it's time for you to get your Bitcoin off of exchanges. This video is sponsored by Envoy, a simple Bitcoin wallet with powerful privacy features. It takes 60 seconds to set up. You can get your Bitcoin off of exchanges right now. There's no middleman. This is the way that Bitcoin was meant to be used. Self-custody. Download it for free in the App Store or the Google Play Store today. Now, back to the video. And so, where does that money come from, guys? The money that hits the private hands in terms of treasury issuance has to come from other places. Because the Fed is not printing money, the Fed is not purchasing these treasuries, somebody has to. And we all know that treasury auctions and treasury issuance gets satisfied every time these securities come to market. It means that we never have an auction in which the Treasury is not able to issue all the securities that it wants to. And in that way, we know that large Treasury issuance will directly crowd out investment of other asset classes simply because the money has to come from private hands because it is not coming from the Fed. And so that's where QT comes into play here. You can see that the crowding out effect happens with more net issuance as well as with QT. So these are two factors that are driving the crowding out effect when it comes to the Treasury issuing brand new securities. And so for the rest of the year, we're going to have a large ramp in issuance. Therefore, we are going to have the crowding out effect hit asset classes. Okay, number 3 and the final one, repo. What is repo and how does it affect the crowding out effect right now in markets? Well, you know all of these treasury securities we just talked about that are coming to market, let's say $1 trillion in new, fresh treasuries that are hitting private hands. Well, how do those private hands afford those treasuries? Oftentimes, and when it comes to banks especially, they buy these treasuries on a leveraged basis, meaning that they're using the repo market, which is a collateralized borrowing market. They use the repo market to fund their ability to purchase these treasuries. So what does that mean? If I'm a bank and I'm about to purchase 10 billion in fresh treasuries, well, that money has to come from somewhere. And if I don't want to sell another asset, I can borrow money in the repo market, pledge those new securities, those 10 billion in treasuries as collateral, and borrow about $9.5 billion to complete that purchase. That way I only need about 3 to 5% of the money. Now, where does the repo money come from? Well, that money is also not coming from the Fed. It's not coming from new money. It's coming from existing money. So that repo funding has to come out of something else to fund these treasuries. So the bank will have to offer a higher yield on the repo charge than other assets are offering. And in that way, the repo market contributes to the crowding out effect because the liquidity that needs to come into the Treasury repo market has to come from somewhere else as well. And so what are some of the places that repo funding can come from? Well, one of them is bank funding. So if banks are lending to each other at, let's say, 5%, and the repo rate on treasuries secured by treasury collateral is 5.1%, a bank is going to likely dedicate those funds to funding a different bank's treasury position as opposed to just lending money to a bank uncollateralized, which happens all the time. So we have 3 areas of crowding out: higher treasury bill yields, more treasury issuance from the treasury, coupled with a lack of buying by the Fed, and lastly, higher repo rates, which will contribute to drawing liquidity from other places into the collateralized lending market for treasuries. Thanks for sticking with me today at the Bitcoin Layer. Definitely subscribe to our Substack at thebitcoinlayer.substack.com, where we talk about all of these issues and give our analysis on global macro and Bitcoin topics. Thanks for joining us today and have a good one. Today's video is sponsored by Envoy, a simple Bitcoin wallet with powerful privacy features. It's time to get your Bitcoin off of exchanges and into self-custody today. This wallet is easy to set up, takes only 60 seconds, no middleman, and you're using Bitcoin as it was meant to be used. Download it today for free at the App Store or Google Play Store. Make sure to subscribe to this channel and hit the bell icon to be notified whenever our next video drops. Thanks for watching.